Okay, good morning, folks, and welcome to the Week Ahead Commentary. It is February the 1st already. Only a couple more months until spring hits. So let's kick it off this week. I'm going to consolidate the focus stock analysis video and the market pulse check into one video because we're not looking all that much at putting on new trades. What we're looking to do more is managing existing trades because I believe that we're going to see one heck of a volatile week ahead of us. Let's kick it off with the advanced decline line. This is a measure of the number of companies that are advancing versus declining. And overlaid in gold, you have the Russell 2000. And in black and red, you have the Wilshire 5000, the total market. And you can see that the Russell 2000 broke down below its prior breakout point. It had a breakout point failure. So you have a lot more decliners on the Russell 2000. Not quite a breakout point failure yet on the total market, but we are putting in lower highs. This is not a bullish chart. Ideally, in a healthy market, you want to see a breakout and a continuation move higher. We're not getting that. Dow Industrial's monthly chart. Okay, January is now over. Where do we stand? Now we want to take a look at the monthly chart to get a feel for what's going to happen in the next several months. And last month, we broke down below key support, the lower band of the rising uptrend channel. We managed to recapture that support level back in December. In January, we failed. Volume to the downside rose. So I think that the path of least resistance right now for the Dow is to the downside. And keep in mind that earnings growth for this quarter so far, and we have a good idea. All companies have not reported, but we have a very good idea of how earnings are going to pan out overall. It's like an election. You don't need the entire election results in. You need the first 25, 30, 40% of the results in, and you can forecast who's going to win. Same thing with earnings. And the trend is undeniable. Flat earnings growth. Earnings growth is zero. When you add in Apple, it's 2.1%. Apple cannot carry the entire market, and even Apple had a rough day on Friday. The U.S. dollar, which I've been warning about for months now, and I am not a Nobel laureate economist, I've been warning for months now, is going to adversely impact earnings. And now, big shock, forward-looking guidance due to the strong U.S. dollar looks weak. This is why we need to follow the charts and not listen to the CNBC commentators because they're reactionary. They're not proactive.